What's up everyone, it's Caddy with MoneyVest. So in this video, we are going to be talking about Palantir. It's been a very long time since I've covered this company, this stock. We've been talking about it for the last several years. This has been a big part of our channel along with Meta and PayPal and of course Tesla and Nvidia and a lot of different companies we've talked about over the years. But a lot of you guys have been asking for an update on this company since it's been a while, and of course Palantir now trading well over $25 a share. It has seen over a 300% recovery since December of 2022, and since then, of course, there's been a lot of developments, a lot of new contracts, a lot of new agreements from a lot of different international markets and other parts of the world, including a lot of commercial clients, and the most important piece of the overall equation is profitability. Palantir is now a profitable company on even a GAAP basis, which is a huge achievement in its own, because as much as it's been around for over 20 years, it has not ever seen profitability on a GAAP basis, and we finally saw that in 2023. So I'm going to break down everything, full update on this video. As always, make sure that you drop a like and subscribe to the channel if you're just joining us for the first time, and the links to our Discord and Patreon is also going to be down below. We're also going to take a look at the technical analysis on this stock to break down exactly where the next key areas of support and resistance are going to be. There is a little bit of that head and shoulders pattern potentially forming on a Palantir, which could signal some weakness if you do see a breakdown below the neckline, but we're going to talk all about that. And like I said, link's going to be down below with that 16% annual discount available until the end of this month, and you get access to all the trade alerts and the trade ideas, as well as all the other benefits and features as well. So this is Palantir trading at just over $25, and we're going to come back to the technical analysis, but really what I want to show you is that it is trading back above its moving averages, consistently after such a long time, because this was the entire sell-off that we witnessed for Palantir since 2021 all the way through December 2022. It was down almost 80%. And of course, from its all-time highs of well over $44, $45, the stock was down over 86, almost 90%. And from those levels, we have seen a very nice consistent increase of over 340%. And what you will notice is that market is very much forward-looking, right? Market kind of understands what is going on with the company, what is going to happen with the company over the next 3 to 4 quarters when it comes to earnings specifically. And before the sell-off even began, we saw a significant amount of earnings misses over here. Consistent misses. You can see 4 back-to-back earnings misses from Palantir, which obviously resulted in significant gap downs and more downside for Palantir. But of course, eventually things changed, and finally everybody kind of woke up to the idea that Palantir is one of the best software companies out there with very high margins. And the most important thing that I mentioned was the balance sheet. The balance sheet is so strong for Palantir that it is theoretically and realistically almost impossible for the company to go bankrupt, because the company has more cash than all of its liabilities put together, and that puts the company in one of the best financial positions ever. Now, as I mentioned, the balance sheet being very strong, the profitability equation being very strong, that's all good news. But the valuation being the other side of the equation, which was always a bit of a concern, because the valuation was always trading at a bit of a premium relative to not only the sector, the industry peers, but also to the overall market and other big tech stocks out there. So this right here is going to be the actual 2023 numbers, and what you will notice is, again, bottom line net income going from about $371 million in net losses to $217 million in net profit, and that is from a $2.2 billion revenue. That's up from $1.9 billion in 2022. This right here is the earnings report from February 4th, 2024. That's when the company reported earnings, I believe. So if you come back, the last earnings were once again on February 5th, basically, is when they reported for the last quarter 2024, which I don't believe I covered earlier. If you take a look at the operating expenses, right? So operating expenses right over here, this is the line item, and total operating expenses sitting at $1.67 billion. Now, what is interesting, and this is the idea behind operating leverage, okay? This is what Palantir has. The key to their secret success here is operating leverage. What that means is that they're now able to grow revenues. So operating leverage, the formula for operating leverage is the delta in operating income divided by the delta in revenue. And what that means is we're calculating the change, year-over-year change of operating income divided by the year-over-year change in revenue. And if the operating income is growing at a faster rate than the revenue growth, that in itself tells you that there's operating leverage, meaning that the company is able to grow at a much faster rate without having to spend more money. Okay, that's where the leverage comes in, because with the same amount of research and development, with the same amount of sales and marketing, with the same amount of people working for the company, they're able to grow their revenues from 1.9 to over $2.2 billion. These are very, very important things to look at, and operating leverage is actually going to be one of the metrics that we look at very closely in our moneyvest.com platform. So the platform that we're building, there's going to be a lot of MoneyVest metrics, and operating leverage is one of those key items that we look for in companies, because we're simply trying to understand that is operating income growing at a faster rate relative to the revenue, meaning does the company has any operating leverage and they're able to be more efficient and grow at a much faster rate. And Palantir does that really well. And more importantly, of course, the net income turning positive $217 million and EPS of just about 9 to 10 cents per share, while shares outstanding also growing a little bit. Now, this right here is also one of the best things about Palantir, and that is to say the cash and cash equivalents sitting at well over 831 million and $2.8 billion in marketable securities. So that's very wise from the company to invest a lot of that capital here for marketable securities, and we're looking at 3.6, I repeat, $3.6 billion in cash and cash equivalents and marketable securities, whereas their total liabilities are $961 million. $961 million. That is, again, literally about 30% of their total cash available, all their liabilities. So in other words, if they use all their cash to pay down all of their liabilities, they will still have over $2 billion, almost $2.5 billion left over after paying down all of their liabilities. That is actually quite insane how strong their balance sheet is. I mean, that's quite literally everything we need to look at when we're looking at balance sheet, is how much the company has cash and how much debt. And in this case, cash is 3 times more than their all liabilities, not just debt, but all liabilities. Now, apart from having an excellent balance sheet, very strong operating leverage, and on the path to profitability, the addressable market is also huge. I mean, Palantir working with Foundry and of course Gotham and a lot of different AIP products and AI, artificial intelligence, being utilized. There's so much data out there that can be parsed through for a lot of companies to make sense, to help them reduce cost and increase revenues as well. Now, the one thing that I have mentioned before, which are some of the challenges for Palantir, number one is that it's a B2B business, right? So B2B businesses are always difficult to scale, because Palantir depends more on the quality of the contracts than as opposed to the quantity of contracts, meaning you're not going to see Palantir sign on 200, 300 more new clients each year. But they're rather going to be signing on, let's say, 100 clients every single year, but the amount or the contract values are going to be much higher, right? So B2B businesses, much more difficult to scale. There's more marketing, there's more sales involved. But that, again, is both a good and a bad thing. Good thing because it can be a more sticky business model where businesses have the ability to pay, are going to be using Palantir's services, and they're going to be around for a very long time. The con is what I just mentioned, because it's much difficult to land a good, high quality business in terms of that contractual value. And of course, it's going to be fewer contracts, but it's going to be higher valued contracts that Palantir is going to be focusing on. So that's number one. Number two is that Palantir kind of restricts itself really from a big tech company standpoint. So for example, Apple, and when you look at Microsoft and Google and Meta, like the companies with the most data, that's why they're called big tech, and companies that have the most data are most likely not going to be using Palantir. I could be wrong in the future. I could be wrong. They could very well go after Palantir and kind of sign on a contract with them to kind of use their technologies to parse through all the data that they collect. But Google, Meta, Microsoft, Apple, Nvidia, like a lot of these companies, that the data that they collect, they've got teams in-house to parse through the data and make sense of that data. That's why they're using, a lot of their, technologies in-house to generate that advertising model. Even Amazon, I forgot to mention, because, the things that you could do in those companies with Palantir software is just magical. I mean, you could literally just change user experience to a point where it's picture perfect, everything that those companies are doing. But again, they've got a lot of those teams in-house to analyze a lot of the data that they collect, make sense of it, grow the revenues, and while also efficiently reducing cost. So, I do think that a lot of the people that are signing on, a lot of the businesses and governments that are going to be signing on for Palantir are going to be sort of mid-tier to somewhat high tier, but it's not going to be the super, super big tech, because a lot of the work that Palantir is doing can be, unfortunately, done, I believe, in-house by a lot of these big tech companies, that they're able to kind of analyze a lot of their data. But again, I could be wrong. We'll find out in the future. This right here is just a consistently growing revenues and gross profit, operating income, again, generating operating income, going from losses to profitability here. And now if you do some very quick math here, so revenue expectations from $2.6 billion to over $11 billion by 2033. Now that seems a little bit of a lower growth rate because, that's a growth rate of just over 20% on a compounded basis over the next, 9 years or so. And that actually does feel like a lower growth rate because a company like Palantir, as quickly as it's scaling, I mean, analysts should be, in my opinion, pricing in for revenues of well over 25 billion dollars. If you're looking at a market opportunity north of 500 billion, if close to $1 trillion because of the amount of data that's available for both governments and businesses. And if Palantir really does solve a lot of these problems and can find more efficient ways for these organizations to grow their revenue and also reduce cost, I mean, this is a no-brainer. At the end of the day, it should be a no-brainer for a lot of these companies to utilize Palantir's software and their services. So revenue expectations are, I would say, modestly reasonable at 20%. I think would be a little bit more conservative, and EPS expected to go from 33 cents to about $1.60, and that again is going to be about a growth rate of about 15 to 20% on a compounded annual basis. So again, it's not a super high growth rate that we're working with, but of course the valuation is indeed really high at over 75 to 62 times earnings multiple. So that's where I feel like the discrepancy really is. I mean, Palantir, as fantastic as a business as it is, of course, we're seeing a lot of amazing things happening with Palantir's business. New contracts are coming on board. Balance sheet's fantastic. The growth is there. Profitability is now coming up. But at the same time, you can find amazing businesses, but if they're not priced well, it's all the same, right? So we're looking at 75 times earnings multiple when indeed the growth rate is 30. So right there, you can kind of do the math and kind of figure out, okay, what's the PEG ratio? The PEG ratio is the price to earnings divided by the growth rate. So if you do 75 divided by 30, we're looking at over 2 in PEG ratio. If you do over here, 62 times earnings divided by 20%, that in itself is about 3 PEG ratio. So over here is 2, over here is 3, over here is over 2.5. So the bottom line is, on a price earnings growth adjusted basis, Palantir still is unfortunately one of the more expensive stocks out there, just considering what the PEG ratio is. Price earnings wise, I mean, if you're comfortable paying 75, 62 times forward earnings, be my guest. That's totally cool. But the idea that I'm trying to share here is that on a growth adjusted basis, the PEG ratio is higher relative to, let's say, some of the other stocks or other industries or other sectors for that matter. But if you are willing to pay for that growth, I mean, then of course nobody can stop you there. If you do some very simple math, so let's just assume that net income, in fact, I think Palantir does provide us some guidance here. We're looking at a GAAP net income in each quarter of this year. Adjusted free cash flow $800 to $1 billion. Even if you just assume for $1 billion in a free cash flow, so let's just do a 5-year DCF on Palantir. So, and then we'll plug in, let's say 1,000. That's going to be, 1,000, that's $1 billion. And a growth rate for between year 1 and year 5. Let's just assume a 20% growth rate, a 12% discount rate, 4% terminal rate, 10% margin of safety, and 0% share dilution. We arrive at a fair value of closer to $9.50. If I go with a 25% growth rate, which I feel like it's going to be a lot more reasonable and a lot more sort of realistic for free cash flow growth here for Palantir, then we're looking at about $11.44 in a fair value, which still warrant about 55% drop needed in order for Palantir to be trading at its intrinsic value. If you go with, let's say, 30%, now we're talking at $13.70. If you go with about 40%, now we're looking at almost $20. If you do a reverse DCF to kind of help you better understand what are the numbers Palantir needs to hit in order for it to justify today's valuation. So if they are assuming for 2024 actual free cash flow at $1 billion, and if I assume for 50% growth, now we're looking at, let's just do 45%, let's just do 47, 48%, let's do 49, there we go. So 49, just shy of 50%. So basically what this means is that Palantir over the next 5 years needs to grow free cash flow from $1 billion to well over $7.3 billion. And if we're looking at a free cash flow margin, right, which was around 600 million, 600 divided by 2.2, about 27%. So 27% is what we're looking at in terms of our free cash flow margin. So really what we're saying here is that 7344, let's see, 7344 divided by 0.27 So really what we're saying is that revenue needs to be $27 billion. So revenue, $27 billion, 27% of that is going to be closer to $7.3 billion by year 5. That would warrant a 49 to 50% growth rate for Palantir and a 12% discount rate, 4% terminal rate. So to essentially conclude, what I'm saying here is that Palantir is a fantastic company with a ton of potential long-term and, of course, excellent balance sheet. So the bankruptcy risk is really low. Every investor, every trader or analyst has to ask themselves this question: is Palantir worth it at $25? Is Palantir a buy at $25? And if you come to a conclusion that it is, then of course be my guest. By all means, do what's best for you. But just be understanding of the fact that valuation is high. I mean, 25 times sales is where it's trading at. And just to give you an idea, that Palantir needs to grow free cash flows by almost 50% over the next 5 years and go from $1 billion to over $7.3 billion. And revenue needs to go from $2.2 billion to $27 billion by year 5 in order for it to justify today's valuation and give us a market-beating return of a little bit over 12%. And that's strictly and purely based on fundamentals. Technicals and momentum, of course, can do all sorts of different things, and the stock can rip to $40, $50, $60, whatever the case may be, purely based on technicals and, of course, momentum. But that would still not take away from the idea that valuations are high and it's expensive. So, of course, I'd be a lot more interested in the 14s. So this right here, very, very strong area of demand. If and when Palantir trades down to that level, that's an aggressive, no-brainer buying opportunity for myself. But of course, we've got a huge resistance and a target closer to $29 to $30 per share, down to as low as $20. It's going to be also a much better reasonable support here, considering that it's been a previous resistance for Palantir. So hope you all enjoyed this video, and let me know your thoughts down in the comment section below. And I know there's going to be some comments kind of telling me that you don't know what Palantir is doing, you know what you're talking about. Look, I agree with you. Palantir is an amazing company. I do agree to the idea that Palantir is fantastic and it's going to do great things. But having a great company and also having a great investment are two very different things. It could be a great company, but not a great investment because it's priced really, really high. You could find the best house on the block. You could find your dream home, but if you're overpaying for it, it may not be a great investment, right? So you can find great companies and great businesses and great assets, but doesn't mean that they're great investments. So there's a difference there. Hope you all enjoyed this video, found it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Links to our Discord and Patreon is going to be down below if you're interested in joining. And as always, let me know your thoughts down in the comment section below. Happy investing, and I'll see you all in the next video.